Did anyone manage to do the project work which we talked about? Let me find out what it was. So I asked if you can find, you know, I asked if you can find a companies with the below criteria using screener website, right? So did anybody tried for fun or anything anybody want to share?
I tried a bit of it.
Okay, should we just give it a try now and see?
Yeah.
So if I again I'm on this site screener.in, then you just need to go to screens and then create a new screen. Okay, and let's look at what I need. So sales growth more than 20% for last year, last 3 years, last 5 years. So what I'm looking here, I'm looking for a business that has been growing their sales for last year, last 3 years, and last 5 years with more than 20% growth. Okay, so I go here, I say sales growth. When you say sales growth, defaultly it accounts for last year. So I would say 20%. Then and sales growth. As on you type sales, it gives you recommendation. So it makes our life easy. So greater than 20%. So I'm looking for companies that grown their sales for last year 20%, last 3 years 20%, and last 5 years 20%. It gives you suggestion here value. So it has to be a percent. So I gave. So when you do 20, that means it's in percentage. Okay. And then what else we were looking? So that is done. So we added this with this three commands, three instructions. Okay. Then operating profit margin 20%. So we want businesses not just growing their sales. We want businesses along with the sales growth. We want businesses to make profit. So we want specific profits more than 20%. So again, this is for last year, last 3 years, and last 5 years. So let's go there. OPM, operating profit margin, again in percentage. So I'm saying more than 20%, and OPM, operating profit margin, it doesn't have 3 years options. No, it doesn't have 3 years. So I have to select only 5 years greater than 20. Okay. So this is also done. No option for choosing 3 years. Okay. So you can, so that's this two. Okay. Now debt to equity is more less than 50%. So basically what again we are looking for a companies who has less debt. We don't want businesses who borrowed too much money, because then they get into trouble when interest rates goes up or if the market dynamics changes. So we don't want to mm, have companies more than 50%. So I would say debt. When you type DEB, debt, you get so many options. So here it's debt to equity we are looking for, and it has to be less than 0.5%. 50% is 0.5. Okay, so this is done. So this is done. And the price to earnings. So we don't want to pay too much. We want all these good qualities of the business at same time. Even though they have all the good qualities, I don't want to pay too much price for them. This is how we make profit, right? I got a best player who is doing best performance, uh, consistent performance, and emotionally he is good. He performs well in different situations, pressure situations. But at the same time, I don't want to pay him too much money if I'm selecting it for IPL or any football club, right? So it's same logic here. I don't want to pay too much money for businesses. So the criteria price to earnings has to be less than 15. So we got this one. This is done. So then we want companies with more than 1,000 crores, 1,000 million Danish krone market cap. So because I don't want we don't want to invest in small companies because small companies they could be manipulated by investors and brokers to increase the share price. So I don't want to go with the companies anything less than 1,000 crores. So market capitalization greater than 1,000. So this is also done. So I can paste it in the chat so you can refer it in the future. So basically now let's run the query. So we got 4 companies that's satisfying this criteria. And yes, yeah. So then you can see if it is still interesting for you to do research, further research on this company. So we nailed down list of companies from 3,500 that are listed in Indian market to 4 companies. So with this criteria we gave, so we are basically choosing companies based on the criteria we want. These are not only the criterias we have to look for. I will also um, show you all different things we have to look for, but this is based on the income statement we talked about. Okay, so then we have balance sheet and cash flows. So we'll be talking them today and coming sessions. Does this make sense? What we are trying to do here? Any questions? Anything you want to ask? So basically, we are using the financial numbers to filter out all the companies which are available to invest in the investing universe and nailing them down to satisfy our criteria. So that's the goal of screeners. You could do the same for global companies using ticker as we were doing last year. We'll soon start this ticker video where you can see how you can nail it down. But this is the idea we are trying to do. Okay, because if you see in global markets, the company countries we selected: India, US, Australia, Switzerland, Denmark, Germany, Netherlands. We have total 67,518 companies. If I just choose this um, attributes, then I get so I basically said the companies has to be, it should not include materials, and it should valuation should be a bit enterprise value versus EBITDA is less than 10, and we said return on assets is greater than 10, then we we got only 456 companies out of 67,000. So this is how you filter the uh, noise and nail it down to the signal. So this is how you should eliminate the noise and nail it down to the actual signal what we are interested in. Okay. Any questions? No. Okay, we will just continue the video we were been watching last week. I just want to finish this one so that we can finalize this. Uh, yeah, let me select this as a separate one. Yeah. So
that he paid $4 million for. This one also provides a profit of 200,000. Everything else equal, which restaurant would you rather own? Yeah, that should be Bob's. Bob has a 10% return on assets or capital, while Stefan has a 5%. Don't take my word for it. Charlie Munger has famously said that over the long term, it is hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you are not going to make much different than a 6% return, even if you originally buy it at a huge discount. While it is true that past performance is no guarantee of future results, this highly depends on which type of metric that you are looking at. It turns out that historical ROA is quite a good indicator for future ROA. Let's say that we require an ROA of 10%. This means that we're now left with only about 1% of all listed companies, which is an awesome thing for your time management. We shall soon check out each company individually, which might be where Ticker really excels. But there's one more thing that I'd like to include in our screen first. Step 3. Growth. Some investors think that growth is the most critical variable to consider when valuing stock market companies. If one could tell the future, it would be. The problem is that historical growth numbers aren't really that reliable for the future. Just look at the impressive development of this company. Up until 2014, depending on your level of optimism, you may have projected something like a 20% growth going forward. However, suddenly that growth stopped, and shareholders who bought at the high price multiples of 2014 and 2015 have faced sluggish returns ever since. This is a large pharma company called Biogen. While I am cherry picking here, it is true that all companies eventually face growing pains. For growth, it is true that past performance is no guarantee for the future. And historical profit growth is even less reliable for the future than historical revenue growth is. Compare this to the strong relationship that we saw for ROA before. With that said, I'm slightly more favorable towards companies that have been growing historically versus those that haven't. So let's at least exclude companies in decline with the help of Ticker Screener. Step 4. Reliability.
so does this make sense? He's given example of so now until here he was filtering with all the so valuation, profitability, and then the growth. Now the third filter he was looking for is the growth. So even in the growth, he gave an example that you can't predict the future. You don't know what would be the growth for the Apple or Google or Tesla or any companies you are looking for. So he gave a example of one company, bio company, where the growth was too good in the initial years, and then when you look at this growth, you may project, okay, my company would grow at least 24% or whatever the projections you gave, but then the reality is different, right? As we see here, the reality was not been as it was projected. So we need to also be conservative. Maybe that's the word I should use. You should not pay too much. You should not assume too much growth for the companies, because of the competition, economic situation in given sector and etc. So you should always give low growth numbers for the com- companies. So let's filter out all the companies. So now here,
growing historically versus those that haven't. So let's at least exclude companies in decline with the help of ticker screen.
so let's take all the companies which are been growing revenues. So total revenue. So we are taking CAGR, stands for compound annual growth. It's a growth with also accounted for compounding. So I can probably explain you that. So then from 2016 to 21, I want all the companies growing revenues zero. So that's the filter here. So we got now 323 companies, 0.48% of 67,000 companies.
Screener. Step 4. Reliability. So, in just a matter of minutes, we have been able to narrow down tens of thousands of alternatives into a short list of about 600 better than average opportunities. If you want the list to be even shorter, just increase the thresholds for the three variables that we've discussed. You've probably noticed that much of the criteria we've used are based on earnings, so the next step is to check that they weren't just a fluke, a one-hit wonder of the investing world. Sort the companies according to the most critical metric, price, and then look at them individually, starting from the top. Here, we happen to find a Swedish company called AIK Fotboll AB. Suppose we click on it and check out its financials. We can clearly see that EBIT, also called operating income, doesn't seem very reliable for the last 12 months. It looks like it could well be a fluke compared to previous years, and is probably not something we should expect that the company can repeat in the coming years. Therefore, let's discard this one and move on to the second company on the list. If we keep excluding companies like this, we'll soon reach number 18 on the list. This is a Japanese company called AJIS, which provides inventory and other retail support services in Asia. If you are looking for undervalued stock market companies, I would say that this isn't a bad place to start. But maybe you do not have easy access to Japanese stocks. Then further down this list, there are a few companies that you might be more familiar with, such as Facebook, Merck, UPS, BHP, and Target. Step 5. Deep dive. Depending on your level of ambition, there are more things to evaluate from here, and Ticker can help you with that too. You can find pretty much all public filings of companies. There are transcripts of live presentations. Heck, there's even a list of insider ownership and recently made insider transactions. Ticker can help serious investors to find opportunities without depending on anyone else. You are not doing what everyone else is doing anymore. You are doing your own research, and in that, you are much less likely to be just another sheep in the herd.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Gordon Gekko might not be the best role model around, but he is right about this one. Contrarianism is a hallmark of a great investor. For bonus points, you could tailor make your screener to fit your own investing beliefs. For instance, maybe you think that EV/EBIT of 15 is a bit too strict. Then I'd first ask you to remember that the higher this multiple is, the greater the pressure on the future performance of your companies. However, if you still don't agree with me on this one, fine. Then increase the EV/EBIT by 50% or something, but be stricter with ROA and revenue growth. Or maybe you want to be even more cautious with companies with weak balance sheets. Then add an additional criteria, perhaps a debt ratio and or a current asset ratio. There's truly a ton of data that you can filter through with Ticker. This is very similar to how I currently find stocks myself. You'll find many of the stocks that I currently own on that list that I showed you before. I've used Ticker for a little over a year. It is the best.
So now he's talking about ticker, but let's look at what companies does it throws up based on the screener. So you could also save the screener so it shows up in the future when you log off and log in again, right? So so we have yeah, in US we have this company. So I would also add one more debt to equity. So let's put the percentage wise. Percentage. I don't want companies to equity financial year. So let's take last. I don't want any companies. It's in percentage, as you can see. Can you see the screen? Or should I need to increase? Yeah, I can also increase. Okay, so it's a percentage value. So I'm giving less than 50%. So now I'm asking again, fish the companies. You know what? I can also reduce this further down. I don't want companies. And I can also increase this further up. I want companies with the ROA more than 12%. Then let's see. So we got only 130 companies. So let's look at any of the companies that rings bell for you. So let me filter with only US. Okay. So this is US. Maybe I can't show you in other countries. So maybe it's only US we should able to see because I don't have the premium. I thought maybe I can show you Denmark, but then I don't have the premium to show you Denmark. So some company in Germany. Okay. I'll go slowly. Shout out if you see any company that you know. No? You forgotten about this company? We all got vaccine, right?
No, yeah,
Pfizer. Yeah. So
but not
okay.
everybody got from Pfizer.
Yeah, sure. But this is one of the company listed here. It could be an interesting if you want to look at it, deep dive. Okay, let me see if there are any other company that we can recognize. Okay, so it's only Pfizer that we should able to find it from this list. Maybe I was too hard. So let me see if I filter it further down. Let's mm, let's select. Information technology. So this is a fun exercise you can do, right? So you could just now what I'm doing is I'm filtering only information technology companies with the same criteria. So I got 18 companies out of 67,000. These are all companies you can see from the information technology. This is Micron. I don't know if you heard this company. They are the one who manufactures the memory chips for computers, laptops, everything. So this is one company that I can recall, but okay. So this is a global screener that you could use and add the criterias how we did for this Indian screener.in. So this way you can further nail it down the companies you want to, investigate if any of them would be interesting for you based on the criteria. So you would be learning more attributes in the future, and then you can add them here as on you add more, learn more attribute. For example, I want a return on equity. For example, return on equity. So I want equity is the value money that the shareholders put into the business, and I want a return on equity should be more than. So for last uh, greater than, so I would say last 1 year return on equity, I want companies greater than 20. So I got 15 companies now. So basically I'm saying all the companies who made more than 20% on the equity of the company. So this is how you could use the tools like ticker and screener to understand the business. The good thing is you are sitting somewhere with internet access. You can look at all the businesses around the world and get understanding of them. That's the beauty I like about investing in businesses. So you could sit anywhere and analyze the businesses, and if market becomes so pessimistic or they are in fearful situation, you go and filter the good businesses and buy them. That's the beauty of this, if you understand this, if you understand what you're doing. Okay, any questions, anything before we proceed? Do you want to do fun exercise with the ticker for global markets next week? Maybe I can describe how we did for screener. We can do similar exercise for global markets, and I'll try to get a premium subscription by next week. Then we look at all the countries, all the companies for fun, to see if we see any Danish company just you can recognize. Okay. Okay. Any questions? No. Okay. So let me go back. So we finished this one, and now let's look at the real company, and let's look at how the financial statement changes for the real company. So I saw CDC investor, he already made a video regarding this, so it would be nice for us to just listen in and see how the financial statements changes for a real company in the real time. Okay.
invite you to join Elon Musk's future great-great-grandchild Bob Musk on his journey to start the first planet-wide restaurant on Mars. This journey will teach you everything you need to know about the income statement, the balance sheet, and the cash flow statement as an intelligent investor. Accounting is the language of business. Much like you cannot understand what type of dish you are ordering if you don't know the language of the menu, you cannot understand what type of business you are buying in the stock market if you don't know financial statements. Other guys read Playboy. I read financial reports. And by the way, don't worry. You don't need a college degree in accounting or math for this. You just need to listen to how Bob makes shady.
So accounting is the language of business. So that's also the reason I'm introducing you this financial statements, understanding, familiarizing with the numbers, so that you would. And it's not that complex. It's just a simple common sense you need to use in order to understand the numbers. You don't need to be a MBA from famous college, or need not to be a mathematician to understand this. It's a simple numbers with a simple common sense behind it.
Deals with the Swedish Mars Mafia and how he beats his second cousin Stefan to build the first empire of restaurants on the Red Planet. 2122. A promise and a betrayal. Imagine a future where we have populated the red planet of Mars. Much is different in this future technology-wise, but not much have changed financial statement-wise. This is probably the only prophecy you will ever hear on this channel. 85 years after his great-great-grandfather put humans on Mars, Bob Musk raised capital for his first business. Believe it or not, the Musk family all started to have so many babies that Bob didn't inherit much money. All he had to his name was 100 megacoins, MC, the crypto of the future.
We've all decided centralized banking is rigged, so we trust more in fly-by-night Ponzi schemes.
When Bob started his business, he added his life savings, 100 megacoins, to his company Mars Donald.
He added initial investment of $100 into this business, which he is starting in on Mars, McDonald's, or pizza um, um, uh, company. And uh, so then if you look at now in the balance sheet, the common stock is $100, because that's the investment the owner of the business started with. That's the reason you see entry here. This is we call, as you see, this is the owner's investment, and then additional paid in capital, retained earnings, and then it becomes total capital. So retained earning means, let's say the business earned another $100 after 1 year, that goes into balance sheet here, $100, and that becomes $200 next year. 100 is the money that the owner put in at the beginning of last year, and then the $100 is what they made, and then it becomes $200. So that's how the balance sheet is added. Uh,
It was financed through the issuance of common stock. We must highlight an essential difference between the three financial statements right from the get-go. The balance sheet is a snapshot in time of the financial condition of a company. The income statement and the cash flow statement describe what happened financially during a particular period, usually a quarter or a year. The balance sheet is a selfie of your physique. The income statement and the cash flow statement are the training regimes and diets you were on during specific periods. So, Bob created his company by issuing shares for 100 MC. In that, He also increased the company's cash position by the same amount. You see, there are two sides of the balance sheet, the asset side and the liabilities and equity side. The balance sheet has received its name as it must always be in balance. This might be the most fundamental idea from the language of business, and so it is referred to as the accounting equation. Assets equals to liabilities plus shareholders' equity. So, what happens when Bob increases the liabilities and equity side by 100 MC? That's right. He must also increase the other side, the asset side. Something also happened in the cash flow statement, but we'll get to that. So far, so good. Bob went on a hunt for his first Mars property. He knew he needed a place on top of a cliff so that people could easily access the fly-through with their cars. Fast in, fast out. He found the perfect spot on the popular commute between Noctis City and Cupola City. The only problem was that Bob's estimations said that the cost for acquiring the plot and building the place would be 250 MC, which was more than he could afford. But it was the perfect place. He had to solve this somehow. Bob went to the Martian Bank of Noctis City to ask for a loan for his business. While waiting for a representative, someone gave him a heavy pat on his back.
Hey, Bob. Long time. What are you doing in a place like this?
It was Bob's second cousin, Stefan. Stefan hadn't always been so friendly to Bob when they were younger, so Bob wasn't too pleased of running into him.
Oh, hi Stefan. Long time. Nothing much. Just applying for a loan for my restaurant.
No way! You're kidding. That's what I'm going to do too. Where are you going to open it?
Uh, Promise you're not opening one right next to me.
Of course not. Don't worry about it. I already have signed papers for one here in Noctis.
Alright, yeah, sure. So it's on this cliff on the commute between Noctis City and...
The Martian Bank agreed to lend Bob 200 MC. This meant another increase in cash and equivalents, and it also meant an increase in long-term liabilities. Remember, a balance sheet must always be in balance.
I hope you understood this. So he want to start a restaurant, and then the place cost him 250, and in common stock, the money he put into the business, it's only 100. So he went to bank to borrow the money, additional money. So he borrowed $200 dollars from bank. So you see in the debt, it's
in
already,
long-term liabilities.
so
Remember,
in debt, it's 200, then 100. Can anybody guess what is the debt to equity now based on this number? So how much is the debt to equity by looking at these two numbers? Yeah.
I think that let's say you invested one MC in it
Mm,
because the debt, if he was in loss, if you'd pay one, you'd get one but lose two because the debt to equity is 1 to 2.
yeah, exactly. So it's he borrowed 200% of 100 what he has. So that's the debt to equity. But remember, we don't want any businesses with a debt to equity more than 50%. So just to give you idea, right? So this is how we are calculating the debt to equity. So we are looking at the money that the business borrowed and the money that the business put in, or the investors that put in, and then we are comparing to find the debt to equity. Okay.
a balance sheet must always be in balance. It also affected the total debt issued during 21-22 in the cash flow statement. We'll cover this statement in more details soon. Said and done. Bob built a beautiful restaurant. For this, he paid a total of 250 MC. The previous landowner received 100 MC for the plot. The 3D printing firm also received 100 MC for printing the place, and then he purchased robot kitchen equipment for 50 MC. Bob paid in cash, so 250 shifted from that line in the balance sheet to a line item called gross property, plant and equipment, which belongs to the long-term assets. The balance sheet isn't just divided by the accounting equation into assets, liabilities, and equity. Its assets and liabilities are also subdivided into current and long-term. Current assets can be expected to be converted into cash within a year or less, and current liabilities are due in a year or less. Anything else is long-term. I wanted to
Basically, he's explaining balance sheet consists of two parts, current and long-term assets or liabilities. So anything that you are owning for the next, cash you are keeping for paying your employees for next 1 year, you can put that under current assets, cash and cash equivalents, short-term investments, and the long-term more than 12 months. It's your plant, your shop, or your restaurant place that goes under long-term assets. And similar for liabilities, right? You have suppliers who supplied material to your business for whom you have to pay the money. So that's a current liability. So he you have to fulfill those liabilities, payments you have to make towards your suppliers. But there are long-term liabilities that you borrow from the bank with 10 years or 20 years loan terms. Those falls under long-term liabilities. Okay. Is it making sense, or is it too complex for you? Is this making sense?
It's a bit fast,
Okay, we can do.
but I understood. But it's
Okay,
going a bit fast.
let's try this one. I'm reducing the speed.
briefly imagine yourself in the shoes of Mars Donalds. Yes, imagine that you are the company. The assets are what you own. You own the restaurant, a
Is it okay, or should I reduce it further down? Then
No, this is fine.
long-term asset. And then you own 50 MC, a short-term asset. On the other hand, liabilities and equity are what you owe. You owe 200 MC to the Martian Bank, a long-term liability. Moreover, you owe 100 MC to Bob as a shareholder, who brought you to life, so to speak. Bob also made his first capital expenditure by purchasing the restaurant, noted on the cash flow statement. Soon we'll be there. Bob went to Noctis City over the weekend to hire his first people, and when he got back, he was unpleasantly surprised. Someone had put up a similar restaurant just on the other side of the Martian flying car road. What the hell? Mars Donalds Plus? Bob got a heavy pat on his back.
Hey, man, what do you think? The cliff makes the fly-through really easily accessible, right?
It was Stefan.
Are you kidding me, man? You promised not to open here.
Sorry, I had my fingers crossed.
What's up with the rip-off? What happened to Stefan's healthy Mars salads?
Well, I thought your name was better. Oh, come on. No one has ever been hurt by a little friendly competition.
Then he quoted some old movie.
It's strictly business.
Bob was furious. Stefan was going to pay for this. Bob ramped up the business quickly in 21-22. He sold Moss burgers, Moss fries, and Moss milkshakes for a total of 100 MC. He purchased ingredients for these items for 30 MC, and the people hired as crew members cost him 25 MC. He entered these costs in the income statement under the line cost of goods sold, which was how most stock screeners back in 2022 would have treated these two costs. An income statement is a record of how net income or profit in a business was generated. You start with the company's revenues or sales and subtract its expenses. The income statement is sometimes referred to as the statement of revenue and expenses, which might be a more telling name. Net income is a good indicator of how much money could potentially be distributed to you as an investor. I say potentially because there are a few more things to consider, and we'll soon cover the most important ones. Bob calculated that his gross profit for the first year was 45 MC. Bob had noticed that Stefan tried to send in spice into his kitchen, perhaps to understand what type of equipment he used there, to copy that as well. Therefore, Bob hired a bouncer for 2 MC. Moreover, he spent 10 MC on an ad targeted to people who often traveled between Noctis City and Cupola City. Then there was the electricity bill. The company that beamed him the energy required to operate the restaurant wanted 3 MC. These 3 costs belong to the selling, general, and admin expenses category. When I analyzed 100 of the largest listed companies, the median COGS expense was almost half of the revenue. SG&A is a vital cost too, at a little less than 1/4. Those are big bites from the potential income to us investors. This is a general theme for the line items presented in this video. They are not.
Does this make sense? So he's briefly explaining how does the revenue
All
is
the
being.
different
Yeah,
expenses.
exactly. Yes. So most of the time it goes for the cost of goods sold or the cost of the the production or services, whatever the business is doing. And then the employee expenses is almost 1/3. Employees are administrative expenses, and then the research and development, etc.
An exhaustive description of what financial statements can contain. Instead, they are the most important ones for you as an investor, as observed when I looked at 100 large and 100 small listed companies. Here's how you differentiate between COGS and SG&A. As a rule of thumb, Bob asks himself, would this cost increase as a direct effect of us selling more? If the answer is yes, the expense will probably go in COGS. If the answer is no, it could end up somewhere else, but most often in SG&A. Will the cost of the ingredients for Mars milkshakes increase if Bob sells more? An obvious one. Yes. So costs of goods sold. Will the cost of the commercial in Noctis City increase if Bob sells more? No. And this cost belongs to selling, general, and admin expenses. Will the cost of properties increase if Bob sells more? Well, kind of. But it takes a ton of sales to outgrow a whole restaurant. So this cost does not belong in COGS. But it does not belong in SG&A either. It does not end up directly in the income statement, even though it was by far the largest expense during Bob's first year. This might sound a bit strange, but just a minute. It seems like Bob is having trouble at the restaurant. Bob couldn't understand how his bouncer missed this guy. It didn't look like one of Stefan's spies, but it certainly didn't look like an everyday customer either. He approached Bob and said,
I like this restaurant, especially the fly-through. If you're ever in need of some cash, be sure to hook us up. Let's just say that we're okay with other types of collateral than ordinary banks. We trust that with enough incentives, everyone pays in the end.
he put his card on the desk and left. The Swedish Mars Mafia? Huh. Bob hoped he wouldn't have to deal with those guys. So, the most significant expense for Bob during his first year of business was the restaurant itself. Yet, this didn't end up in the statement of revenue and expenses. That might sound a bit strange, but it is because
Tino, you have a question?
Yeah, it's a bit unusual that mafia shows up at your restaurant and say you need to pay.
Yeah.
Normally, it wouldn't happen. That they're just adding extra,
Yeah.
right?
Yeah, but that's not the case in all the countries. Some countries have this because mafia wants to make their black money to white, so they use different paths to do this. Businesses could be one of the path. You saw what
Oh,
happened with the Danske Bank, right? Somebody deposited money in Lithuania
mhm.
and other countries. Basically, it was the mafia money which was flowing into the system, and then Danske Bank got the penalty with that. I mean,
Just so
I'm
that they
just
can swap
yes. So they are
uh,
making black money to white, so
white
that
money.
they
Yeah.
this cost is expected to be useful for a very long duration of time. Therefore, it is capitalized, which means that it is added to the balance sheet as an asset rather than being expensed directly in the income.
So he's explaining this, $200 dollars investment he made into the, sorry, $250 he made into property, plant, and equipment. So he's telling it doesn't shows up in the income statement, though it's a major expense for that year because he established this restaurant, right? But it doesn't shows up in this income statement anywhere $250. And then the reason it doesn't shows up is the this is a long term investment. It's not 1 year expense, right? This property or the factory that any business builds or the plant or equipment they purchase, there everything has a lifetime. It may have 10 years, 5 years, 15 years lifetime. So that is tracked in balance sheet, under balance sheet, not in the income statement. So any long-term investment in nature, those things are captured in balance sheet, and then they depreciate that. I know I'm using some strange words that you never heard, but bear with me. Ho- Over the time, you will familiarize with these words, but bear with me. So depreciation is something you are writing off the money you invested. For example, Bob bought property, plant, and equipment for $250, and let's assume it has a life of 10 years. So then he can depreciate this by $25 every year for 10 years to reach $250. So he's taking that out from the here. It will come here under depreciation and amortization. So he will do $25 this year, next year $25 again, year after next year $25, likewise until 10 years. And now you can ask why it's only 10 years, because the lifetime of the equipment and plant that he purchased has 10 years. What is the lifetime of the iPhone that you are using at home? Can anybody guess?
Could you repeat the question?
No, the lifetime of the phones or electronics you are using at home. For example, your laptop or phone
15
that you're
years.
Okay. And did you see any phones around you that are 15 years old?
No.
So 15 years definitely not the right answer, right? So just guess again what could be the lifetime of the phones and the laptops that you see.
10 years?
We have some very old phones at home, but we don't use them. They're like
It's
five,
a
6 years old.
Yeah, exactly. So it typically electronic devices 3 to 5 years. After 5 years, it's not usable. Exactly, it's there, but you can't use it. It's an old version. Nobody want to use it. Doesn't have all the features that you want. So it can be 10 years, but many people use it 5 to 6 years. I have a phone which is 9 years, a smartphone. I still use it, but yeah, it all depends on the people. But typically, yeah, it can be very well 10 years, but it all depends on the usage of the user. So similarly, businesses also have a any investments they make for properties, plant, and equipment, they have a lifetime. It can be used for 3 years, 5 years. They decide upfront, and then they depreciate that value every year from the income statement. So, okay, I see we reached to the end of session. Any questions you want to ask? This, I guess, you should able to watch this video when you have free time. This gives a very good idea, and we'll continue with the same video so that we get a understanding of how businesses start their business and how it grows over the years. So now we are at the point of first 1 year, how much money he made and how that money is moving into balance sheet and other cash flow statements. But in this next section of the video, we would see how does it grows over the years to understand. But the basic idea is how the income statement, balance sheet, and cash flow statements are getting updated in the real time, as you saw. So first, when we saw the income statement, it was all empty. Nothing was in the income statement because business did not made any money. Even in the balance sheet, nothing was there except the $100 that the equity that the owner put in, Bob put into business. So it started with equity, then all of a sudden it's been filling up in the income statement, balance sheet, because he went and borrowed money from the bank. So $200 showed up in the long-term debt. So with the $300 in pocket, he went and procured $250 worth of plant. So things like this, getting updated in the balance sheet and income statement and other statements, real time. Okay. Any questions before we close? Is it been useful this video, or you think it's too
Yeah,
complex
I
for
think
you?
it's useful.
Okay, good. And for next week, try to do the similar exercise we did for Indian companies, for global companies using ticker. Try to do that. Then I can also show you how you can do the same variables in ticker next week. Okay. Until then, have fun. And if there are no questions, we'll close it for today. Okay. Thank you. Have a good
You're
weekend.
welcome.
Bye.
Bye. Bye.